Today, we're going to look at two high-yielding real estate investment trusts that are very popular on platforms like Seeking Alpha, Substack, and even here on YouTube. One is a strong buy and the other is a sell in our opinion. Those two REITs are Getty Realty, ticker symbol GTY, and NNN REIT, ticker symbol NNN. Both are net lease REITs and they are historically cheap, offering high dividend yields and trading at relatively low valuations relative to many of their close peers like Agri Realty or even Realty Income. But some stocks are cheap for a good reason, and we think that Getty deserves to trade at a discount, yet NNN REIT has been unfairly discounted and is currently mispriced by the market. So what's wrong with Getty Realty? Many investors are buying it today because it seems to check all the boxes. It offers a high 6% dividend yield, it has historically managed to grow its FFO per share by about 5% annually, it has strong tenants, a good balance sheet, and a shareholder-friendly management team. So on the surface, it would seem like a great REIT, but there is one main issue with it. It's almost exclusively invested in gas stations and car washes, both of which we view as higher risk net lease categories. Car washes commonly say at higher cap rates than most other net lease categories because there's little barriers to entry, and these are highly specialized properties that will be difficult to release in case of a vacancy. Unlike a typical net lease property that can be released to a large range of different businesses, car washes can only be car washes. And if your tenant default, it clearly means that the location didn't work for them, and so releasing it to another car wash could be very difficult unless it's done at a very large rent cut. The issue today specifically is that there is potentially an oversupply of these properties. They are relatively cheap to build, and many of these companies were flush with private equity capital in recent years, allowing them to expand all over the place. I suspect that we'll see a growing number of lease default in the coming years, and this could significantly impact the market sentiment of Getty Realty. But my concerns do not end there. Getty's largest investment is today in gas stations. It has very high exposure to them, and while they're doing really well today and likely will for a long time to come, I fear that the growth of the electric vehicle industry will eventually become a significant headwind for gas stations. More than 2.5 million electric vehicles were sold in the US over the past 48 months alone, and electric vehicles and hybrid sales reached about 20% of all American vehicle sales in 2024. And even despite Trump's less pro-electric vehicle agenda, analysts still expect the growth to continue this year. The Edison Electric Institute estimates that nearly 50% of light-duty vehicle sales could be electric by 2030. I think that this may be a bit too optimistic, perhaps not just a bit, but a lot too optimistic, but it clearly shows that there is rapid growth in this industry and expected to continue for a long time to come. Electric vehicles are commonly charged at home overnight, so far fewer stops are needed on a day-to-day basis, and I realize that gas stations today have become convenience stores, but you're still far less likely to stop at one of these convenience stores unless you need to pump gas. This means that many of these properties will likely need to be converted into another use over the coming decade, and the issue here is that these properties are affected by significant environmental risk. And back in the days when I worked in private equity, we would intentionally avoid these properties because of this specific reason. There are always some spills and some leaks, and rectifying that can be very expensive. And this will become a very serious topic, we think, once the properties need to be redeveloped, because future buyers and tenants will want to make sure that they are not buying a property that's on a site that's contaminated. These reasons explain why gas stations commonly sell at higher cap rates than most other net lease categories. You take higher risk for potentially earning higher returns. But so this means that Getty is potentially facing near-term risks with its car washes, but also long-term headwinds with its gas stations. And what I fear is that even if its cash flow keeps on growing, the market could eventually turn sour on Getty if and when it becomes more concerned about these risks. So now let's compare it to NNN REIT, which is far better diversified. Its biggest investments are in automotive centers, regular convenience stores, restaurants. It has a lot less exposure to car washes and gas stations. Therefore, we think that NNN's portfolio is far more resilient. They did not put all their eggs in one basket. They did a much better job at mitigating risks by better diversifying their portfolio. And the proof here is in the results. NNN's portfolio has generated such consistent and predictable cash flow that has managed to grow its dividend for 35 years in a row now, and that's despite the dot-com crash, the great financial crisis, and even the pandemic. NNN then also combines its defensive portfolio with a conservative BBB plus investment grade rated balance sheet that enjoys exceptionally long average debt maturities of 12 years. In comparison, Getty only has a BBB minus investment grade rating, which is just one notch above the junk rate, and it has a relatively short 4.9-year average remaining debt maturity. And so, while its balance sheet is still reasonably good, it's going to be much more heavily impacted by the surge in interest rates. And so with that in mind, I just can't make sense of why Getty is today trading at a higher valuation than NNN REIT. It has, in my opinion, a weaker portfolio, a weaker balance sheet, and even its management, while good, does not deserve the same premium as NNN, given that it has a far longer track record of excellent performance. I think that at these levels, NNN REIT is a clear buy. Getty, on the other hand, is not particularly expensive, but it's not cheap either. If I owned it, I would likely sell it in order to reinvest in NNN REIT. Today, NNN is one of our largest holdings in our retirement portfolio at High Yield Landlord. It's, in our opinion, one of the best opportunities in the net lease sector, far better than Realty Income as an example, which is probably the most popular REIT in this sector. But if you want to access our entire portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. Otherwise, I would greatly appreciate it if you click the like button, subscribe to the channel. That always helps me to keep on growing. Thanks so much and see you at my next one. Bye bye.